Flat Earth Trading Society members. This is Rob. I'm joining you here. Before we get started on our first trade starting August 1st, 2023, we have to lay down some ground rules for exactly what we're going to do when we get into one of these positions. Now look, at the Flat Earth Trading Society, our belief is that the entry is a very small part of the trade and that the exit is the most important part of the trade. However, when you go out there and you read books, you watch videos about trading, 98% of everything is about the entry. It's all about the entry and nothing about the exit. We believe at the Flat Earth Trading Society that the exit, also known as position management, is the most important part of every trade, and that's where all your focus should be as a trader. So what we're going to be doing, we're going to be using randomized methods to choose a stock, sometimes a currency, maybe a future. Look, we're going to be doing crazy things. We're going to be spinning wheels. We're going to be rolling dice. We're going to be throwing darts. I'll have a Ouija board in here at some point. We're going to be using random methods and then using a strict methodology for position sizing and whether or not we are long or short. And that's what this session is about. We're going to lay down the ground rules for when we do enter a trade. What are the ground rules behind it? So let's jump into it. Let's answer that question. What are the rules? What are the rules of entering a trade at the Flat Earth Trading Society? Let's lay down the rules of entries at the Flat Earth Trading Society. We will be using a daily chart, unless our random methods give us a different time frame. Every so often, I'm going to throw in a wild card. We might be on a 1 hour chart. We might be on a weekly chart. Everything's going to be done at random. Rule number 2, the stock that is chosen or whatever's chosen must have movement. There's lots of stocks out there, especially penny stocks and low volume stocks that just don't move anywhere. I don't want to be messing around with those. Neither do you. I want them not to be part of our experiment. So we're going to be using stocks with 1 million or greater daily volume and above $10. That will pretty much solve this problem. And rule number 3, we are always going to be trading with the trend. I'm a huge believer in trend following, and you should too. Because look, if there's anything that's been studied over and over and over that can give you an edge as a trader, it is trend following. Now at Maverick Trading and Maverick Currencies, we have a very, very famous saying. We say this at least once a week to our traders: trade the market in front of you. Not the market you want it to be, not the market you think it should be, trade the market in front of you. We are really bad as human beings to let our confirmation bias get into the way of good trades. One of my favorite studies was done right after the US presidential election in 2021. What happens is they were asking Republicans and Democrats, do you feel like the economy is getting worse? Now, when Trump was president, Republicans said, no, the economy's great. And Democrats all said, yeah, the economy is getting way, way worse. After the election, they did the same poll, and they did it completely switched. Democrats said, oh, we think the economy is getting better. It's great. And all of a sudden, Republicans said, oh my gosh, this is the worst thing. This is the worst economy ever. Economic activity didn't change at all during that 1 month. What changed? The perception of the market. All of a sudden, I had to be beating on my Republican traders that they needed to be long. Hey, look, it's a bull market. And it was ironic because I was having to beat up my Democratic traders over the last 4 years saying, hey, it's a good market. It's a bull market. Be bullish. As you can see, it was nothing about the market. It was all about the bias. So we're big believers in just trading the market in front of you and trading exactly what is on the screen. And trend is one of the most easily identified things in the market. And it's one of the most studied things. There are hundreds and hundreds of studies that have shown that past performance is indicative of future performance. It is proven. Now look, I'm going to spend just a second here going through just one study. I'm going to include the link of a lot of the studies that I like in the description below. Also, if you see that little card in the top right, that card will take you to a Maverick Trading video done on trend following where we get into a lot of these studies. And we've done a lot of proprietary studies ourselves at Maverick to really prove that, yes, it definitely does give you an edge. The one I did want to go over was called the Momentum Study. It was a very broad study. It studied hundreds and hundreds of stocks. And basically, what they wanted to know was The stocks with the highest and lowest returns over the past 6 months. Is it good if you buy them and sell them short? And what they found was yes. They found that the top performing stocks in the upper 10th percent, which is indicated by the P1, that's the upper 10th percent. This is their return over the next 6 months. They did better than the overall market by 40 basis points. And they beat the bottom 10% of stocks as P10 by 123 basis points. Over that year, the top 10% of stocks were positive 66% of the time over the next 6 months. Awesome study. But I want to point out one anomaly. Take a look at this little chart down below. In January, it doesn't work. At Maverick Trading, we are trend traders for 11 months out of the year, but not in January. January is reversals. People are rebalancing portfolios. They're selling winners that they didn't want to sell in December because of taxes. They wait till January, sell those. They buy the underperformers. They rebalance their portfolios. January is like the only month where the data says that it's not a good idea to be a trend trader. There are tons of studies out there. If you are skeptical, then go ahead and look up those studies, and you'll see that trend trading does work. So that is going to be our golden rule. That is going to be the only technical analysis we do whatsoever on the entry, and it's just going to be the general overall trend. We're going to always trade with the trend. What we need to do is we need to quantify. What does that mean? Now look, there's lots of ways to identify trends. We could do pivot points. We could do Elliott wave theory. We could do anything. But look, I want this to be simple. I want this to be to where even a 5-year-old could copy this. We're going to use a moving average. And not just a moving average, we're going to use the slope of the moving average. Look, everyone should know what a moving average is. If you ask for a 20-day moving average, it's going to take all 20 days, add them up, divide by 20, and then do that every 20 days. If the moving average is moving higher, the stock by default is also moving higher. The moving average can't increase the next day unless it had a better day. Hopefully everyone sees how that works. So we're going to be using a slope of a moving average, and we're going to be using a 13-day EMA, Exponential Moving Average. It's a weighted average where the most recent day is scored higher than the last 13th day. And here are the rules. Very easy. If the slope is up, we go long. If the slope is down, we go short. How easy can that be? And actually, let's go ahead and jump into it and see how easy it is to identify trend just using a slope of a moving average. Here is Microsoft. As you can see here, we have just turned on the line and the slope is actually headed down. If we chose Microsoft, we would then be short Microsoft at this point. We are going to take the position and then we're going to implement our position management strategies where we are going to sell it if it's a loser and hold it if it's a winner until it's over. As you can see here, this stock followed its moving average. Now it is no longer a sloping moving average. Okay, so here we are. Let's say that we draw it again. This is pretty easy to see. Look, you don't need to be a rocket scientist. You don't need anything. I'm telling you, a 5-year-old could say, hey, is that blue line going up or down? They look at it in a second, they'd say, it's going up. So we'd go long and you can see that's the trade. So that's all we're going to do, which is simply up or down. But wait, every so often we're going to get this. Uh-oh. Is it up or down? If it's inconclusive, we just have to pick something else. Those are the rules. Rule number 3. If the slope is rising on a 13-day EMA, we buy it. If the slope is falling, we sell it short. And if it's flat, we just pick a new symbol. And rule number 4, position sizing. We're going to set our entry price and our stop price. Next video, we're going to be talking about our position management rules. But for this one, our entry price is basically the price it is when we draw the stock. And then we're going to choose our stop price. We'll go over that in the next one. And then we're going to make it a position size equal to 1% loss if the stop is hit. Let's talk about position sizing. This is one of the biggest mistakes I see as a manager of a prop firm, position sizing. Look, in normal trading, we have the tendency to overestimate our ability. Look, we all think we're smart. We've all done some reading, we've all done some of these, and we think we're smart. there is an effect called the Dunning-Kruger effect. And if you take a look at the Dunning-Kruger effect, it means that when you have no information and no experience, you think you know nothing. The second you get a little bit of experience and knowledge, all of a sudden, your confidence goes to the highest it will ever go. And then all of a sudden you realize it's harder than you thought. And at some point you get to the point where you're dejected, saying, oh my gosh, I'm never going to learn this. And then as you put in the time, you gain competence, and then you get that confidence back. This is the Dunning-Kruger effect. And one of my favorite sayings about the Dunning-Kruger effect is that the first rule of the Dunning-Kruger club is that you don't know you're in the club. You don't know what you don't know. So let's talk about position sizing. In normal trading, we all think we're smart. So we say, oh, this is a good one and that's a bad one, and I'm going to do more on this. That's wrong. You need to have the same position size for every single trade you make. Now, this is where the flat earth trading, we're going to do it way better, because look, we are under no illusion that we're smart at this. We're going to be throwing darts. We're going to be picking ticker symbols out of a hat. We're going to be doing the dumbest things ever. So all of a sudden, we don't have this overconfidence. And because of that, because we're just picking things at random, we are going to be perfect at this. Now, look, you should be doing this every single time as a trader. There should never be one trade that is more than the other or is more important than the other. There never should be. It should all be the same, because we literally do not know what is going to happen. I want to give you my 10 trade analogy. I give this to every maverick trader as they come in the door. Here it is. You're going to make 10 trades over the next week, month, year. Who cares? I don't care. The only time you're ever going to put your money on the line is when you're convinced it's a good one. Now think about that. You're going to look through lots of charts and lots of things, and there's going to be ones that don't really fit. The only trades you are going to make are the ones that you are totally convinced are good. And you're going to make those trades. And over the next 10 trades, you're going to click the button. Guess what? 4 of those are just going to stink. They never went your way. They were a loser the whole time. They just stunk. Okay? And so let's say that each one of those losers was a $100 loss or a $400 total. Another 2 trades, even though you tried really hard, they didn't really go anywhere. They just fizzled out, and they went up a little bit and down a little bit, and they just ended up for a break-even, 0 gain. And then 2 of the trades that you made, they ended up being okay. Not great. They went up a little bit. So let's say they made $100 for $200. And then 2 trades were great. You knocked it out of the park. Those were $300 for a $600 gain total. As you can see, this is a profitable trader. They were 50-50 win-loss, but they had a much better profit factor because they sold their losers and held their winners. Let's take an analogy of what most amateur traders do. What they do is they'll go in and they will, again, have the same thing. They'll have 4 bad trades. They'll get out, $100 loss. They'll have 2 break-evens or $0 gain. And because they can't handle it, they sell their winners too soon. So those 2 winners that went up to $300, they couldn't handle it. They sold them too early. And as you can see here, this is a break-even trader. All because they weren't able to hold their winners. Now look, this is okay. If people are doing this, at least they're break even. Most amateur traders, this is how they trade. They get in, they have 2 bad ones for a $100 loss or $400 total. They have 2 break evens for a $0 gain. They have 4 okay ones for a $100 gain, but they had 2 of the bad ones. Remember the other traders had 4 bad ones? Well, guess what? They didn't want to take their loss. They held on to their losers. And you can see they got really bad and they ended up being a $300 loss. This trader is still a 50-50 win-loss trader, but take a look at it. This is a losing trader. This is what most people do. This is why we're doing flat earth trading, is to show you can't do this. You will not make it if you do this. You need to understand that every trade, we have no idea what's going to happen. Even if you have the most confidence you've ever had, you are clueless. Anything can happen. You have to go into every trade fully understanding that they might be one of the worst trades you've ever made. It might be one of the best trades you've ever made. You just don't know what it is yet, and you have to let the trade develop in order to find out. And if you have that attitude, you're going to position size everything the same. So let's talk about position sizing. We're simply going to take our entry price, the price at the time of our random selection, and we're going to find our initial stop price. We're going to cover that in the position management video next. And then we're simply going to go into a position sizing calculator online. You put those numbers in. We're going to use 1% risk, and it will simply spit out our position size. Let's go through an example of someone going on to an online calculator and putting in the position sizing. I'll put up a link to our free tools in the Maverick Trading website where you can go on and get a position sizing calculator. There's lots of them online. It's a very simple process where you just have to fill in the dots here. So again, QQQ, you're going to say, okay, that is simple. Go ahead and get the quote. Choose long or short. And then you basically put in your account size. So we're going to start off with a $100,000 account thanks to Maverick Trading and Maverick Currencies. At this point, we're going to put 1% of risk. And the next thing we need to do is, where is our stop price? So we're going to put in our stop price. Look, I'm just going to throw in a number here. We're going to throw in $370. We are going to determine that in the next video of where that stop goes. We hit calculate, and here it is, 109 shares. So this gives us the results that we're going to buy 109 shares. We have $1,000 at risk, stop price of $370. It's that simple. Let's go over our rules of entry one last time. Rule number 1, we will use a daily chart unless our random methods give us a different time frame. Number 2, the symbol must have enough movement. I don't want to deal with junky stocks that have no volume, so we're going to look for stuff that has enough volume. And if we say above $10, that pretty much gets rid of most of the stocks that are going to be very boring and really not go anywhere. Rule number 3, if the slope of the 13 daily EMA is up, we go long. If it's falling, we go short. If we don't know which one it is, we pick a different symbol. Very simple. And number 4, we establish our entry and stop prices. We'll go into position management next video, and we simply go onto a calculator and say, what is a 1% loss if our stop is hit? Those are the rules for entry. As you can see, super simple, super easy. We're going to get into the more difficult and complex part in our position management video next. Thanks for joining me, everyone, and thanks for joining the Flat Earth Trading Society. August 1st is when the first trades go up on the board. Goodbye, everybody.